There are different kinds of inflation. I'm not particularly worried about the classic supply, demand pressing up against supply, although we'll find out soon because there's something like 10% of GDP stored in financial assets that's going to be coming out. And so it's likely that there's going to be a big pickup in demand, and that will probably raise prices significantly. And it also depends how you count for inflation, because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things I think are, and if you went to a 3% inflation rate or some bounce, that's not one of those things that gets me very nervous or very excited. The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments. It pays not to own cash, certainly not cash, where you get no interest rate of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, to borrow houses right now, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon, and the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect. So that's what it looks like to me, the whole picture of the low real interest rates, and then also the worries about the supply-demand, monetary inflation, and also the Fed tightening.
Ray, you just mentioned that you potentially see the dollar heading down. So is there a fundamental threat to the dollar that comes out of this?
Yes. I'm just dealing with the mechanics. The way it works is you sell a lot of bonds. So now who do you sell the bonds to? And when I look around and calculate who owns the bonds and what they have to buy and what the incentives of buying, they're bad. And in fact, you could see dollar selling of bonds. What that means is then the Federal Reserve is in a position of either seeing rates rise because there's not enough demand to meet that. In fact, if they start selling, it would be a very bad situation. And that they can't let that happen, because that would be very bad for the economy and markets and all sorts of things. So we have to keep in mind where we are. We're at the end of a long-term debt cycle. And that means that the Federal Reserve will have to do what they did last time, which is to buy a lot more to prevent the interest rates from going up. That's very non-cyclical. It's one of those cases where, in reserve currencies, it's a very dangerous thing. Now, you compare that with alternatives. First, the best alternatives are other asset classes. But also, let's say China, for example. I think the situation that we're in is quite similar to the going from the late 60s into the early 70s, when there was a different core inflation rate in the United States versus Germany and Japan. It's a different balance of payments situation. We're in basically a balance of payments deficit. They're in a balance of payments surplus position. That means that they chronologically are worried about imported inflation, and there's favorable capital flows. So I think that that's negative for the dollar, particularly against Asian currencies.
I think that the Fed, though, will argue that they are actively looking to have that overshoot in inflation, the change of approach in terms of the average inflation model, in order to sort of reset the system and indeed get that wage growth through to parts of the economy that perhaps have not seen it over the last few years, and that could be more politically sustainable long term. So Ray, do you see that is an argument that the Fed could make, that it's worth some short-term risk to achieve that more sustainable outcome?
As I mentioned, I think if you see break-even inflation rates go above 3% or something like that, and you see that spurt, then you have the dilemma of the tightening of the monetary policy. As I said, I'm not particularly worried about that particular inflation.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now let's continue.
The other things that worry about me are the whole shift in terms of the quantity of debt money that's being produced that goes into create bubbles, creates an enormous amount of liquidity, and that I think will be manifest by either a rate rise tracing inflation or dollar decline. And I think then we also have to deal with the changes in the political situation, the wealth gap situation. With the wealth gap is the left-right question. There's a lot of conflict in terms of left-right politics. There's a big move, pretty much probably, to more left politics, believing that there's not enough fair share of incomes and so on. And those will create structural changes that will have effects. The amount of money which has gone to profits has increased from about 6% of revenue to about 14% of revenue. And that's decreased the share that's gone to incomes. Those things could be structural changes that shift the wealth and income. I think we're here to those that are going to be more beneficial, let's say, to workers than to capitalists, I think, in general. That's particularly a U.S. issue. It is a European issue, too, although it's a world issue, but it differs around the world. So I think those are the bigger issues, that and the rise of China and what the rise of China means. Those, I think, are the bigger issues. I think Larry and I agree that this is looking more like the late 60s transitioning to the early 70s. And then I'll also say, though, and that has implications for the balance payments in the dollar. So we've covered that. I'm more worried about the inflation in financial assets and what that means for returns and bubbles that are developing, because there's a massive amount of liquidity around, and it's being thrown around so that it's a difficult environment for those returns to be justified. I think we're building kind of a bubble. So I think inflation in financial assets and so on is an issue related to liquidity. Anyway, you think about it, what's happened is the net worth of Americans and most people in developed countries is higher than it's ever been. I mean, all of a sudden, it was a big boost to net income, but yet production isn't. So what you've seen is a lot of people got a lot of money, which they're still holding, and they put it into the stock market and everything, and interest rates go down and they borrow. And that is a dynamic that creates a bubble. And that's what I would say is the main issue. I'm just saying the mechanics. When you have the liquidity and you drive down real rates and you drive asset prices up, that doesn't mean they come down. It just means liquidity drives those for their particular future returns. I think we know that. Probably Larry and I agree on just saying it very simply. there's a ton of money around, and the value of money goes down. And how much it goes down relative to goods and services and how much it goes down to financial assets, it's going to go down to both. And that raises financial assets and it changes capital flows in important ways. I think that it's easy to say that the Fed should tighten, and I think that they should. They put on the brakes a little bit. But I think you'll see a very sensitive market and a very sensitive economy, because the duration of assets has gone very, very long. And just the slightest touching on those brakes has the effect of hurting markets because of where they're priced, and also passing through to the economy. We have to keep in mind, since the cyclical peak in 1980-81, every cyclical peak in interest rates and every cyclical trough has gone steadily below the one before it until we've hit zero. And then every quantitative easing, in other words, purchasing of money, buying of money and purchasing of bonds, has been greater than the one before it. That is a debasement of the value of the currency in one way or another. So I think the challenge of the Fed is going to be able to balance those in a highly political sensitive environment because of this wealth clash. So it's a difficult position for the Fed, I think.